Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent. I just ended up recording this 45-minute video and it was way too long, so I'm going to try and make this super short. I've already done the screening process. I have 5 stocks here that that made it through the whole process. So we screen these first of all for their DARS rating system. You can see the DARS rating system here on the board. Anything below or above 2.6, 2.6 to 3.5 is neutral, recommended 3.6 to 4.5, highly recommended 4.6 to 5. That's the DARS rating system. If you pause the video, you'll see how they are scored. Basically, trading near 52-week high, dividend yield under 1%, over 10% is either not worth it or highly risky. Dividend reliability, how's that payout kind of going forward? Does it have a 50% or less payout, or is it pretty risky at 80, 90, near 100% payout? Dividend uptrend over the last few years or going forward, how likely are they to continue paying out and increasing their dividend over the next few years or over the next several years? Earnings growth over the next 4 quarters, are they expected to grow and continue raising their estimates going forward? That's basically what it measures. I then screen these stocks, heading over to dividend.com, X dividend dates, punch in these dates, 23rd through the 27th, hit that search button, sorted these by the DARS rating system. If you don't have a logon, you won't see these, but it's completely free to get a logon. You'll be able to do a free searches per day. And I copy these over into my spreadsheet, got my spreadsheet here. I then removed all the stocks here that had a dividend yield of 1.5 and below out. So here, what happened was there's really not that many above a 3.6. 3.6 is recommended. So here, 3.6 what I got is here. So what I did this today is go down to 2.6, which included CVS, and they actually made the cut. So we're going to be covering them here in just a second. Okay, so here are the stocks that kind of made it through the list. Of these 14 stocks, here are the 5 that ultimately made it through my screening process. Now, what did I screen them for? First off, it was dividend yields. Anything with a dividend yield under 1.5, I knocked it off right off the bat. I then looked at price to PE ratio of 25 and below, or above, I'm sorry, and knocked those off. So right now, the S&P 500 has a price earnings ratio of 24.34. I just bump it up to 25, knock anything above 25 off. Dividend yields here, S&P 500, 1.81, just round it down 1.5. That way, some of those growth dividend stocks such as Apple, Nvidia, Activision, Blizzard, Starbucks, those have they often have a lower dividend yield. So I'm not going to be knocking some of those growth dividend stocks out. And that was my first screening process. I then looked at PE ratio and forward PE ratio over the next, are they expected to decrease? So Lowe's is expected to go from a 21.89 PE to a 18.44, and so on. All of these companies are going to be decreasing PE ratios over the next over the next year. Here we have Fastenal 23 to 21. We have Lakeland Financial 20 to 16, and United Financial Bancorp 15 to 14. So they all passed that test. Next, I looked at over the last 10 years, how are their revenue, net income, and free cash flow. So here, Lowe's, for example, they have been, change data format, they have increased their revenue by, if we divide this number, so this is over 10 years, we take this percentage here, divide it by 10, that gives us our yearly, year over year changes. So here, 42 by 10, that's 4.26% revenue increase year over year, 5.7% net income year over year, and 23% free cash flow over the last 10 years. Same thing with these other stocks. CVS Health, triple digits there. Fastenal, triple digits. Lakeland Financials, triple digits. And United Financial. So these triple digits, you just divide them by 10. 51% free cash flow, 46% net income, 33% revenue year over year. Now, they all passed that test. Next test I looked for was I knocked a couple of them out. I basically knocked the remainder of them out either because they hadn't had any dividend growth or they had a couple other issues with them. But here are the stocks and why they made the list. Besides the screening process, let's go over their basic financial metrics. So what I like to look at really quickly is their current price to book value and their current price to sales. So price to book for Lowe's is at a 14.27. So value investors pretty high for a value investors, but at the same time, over the last several years, the stock has been climbing, which is just kind of staying in line with their price. So I would consider that still in line with their price changes here. Their price of sales has been pretty flat in comparison to their price. And if we bring in Home Depot, that's the only stock here, that I recognize is Lowe's. If we bring in their comparable and we bring in, what am I doing? Price. If we see Home Depot here, again, their price and their price to book value has stayed about the same, and their price to sales has stayed pretty flat. So that's pretty common there. Price to sales staying pretty flat. Price to book and price has actually climbed in line there. So that looks pretty, comparable. Okay, so price to book, price to sales, that was the first check. It doesn't quite meet that value investor rule. Here we have price and dividend yield for Lowe's. What I like to look for is my check 2. I like to look for a stock that's currently trading with a yield over price. Here Lowe's has came up recently as of looks like maybe May, June. This stock was trading at an $80 point, has climbed up to $100 now. It is now over that yield. If you had bought this stock back in what appears to be May, you would have locked in a 2% yield on cost. You would have bought it at $80. You would be up several percent right now. And you would have, kind of going forward, you would have a lot less, less risk than if you were to invest in right now. Okay, so that's kind of like my check 2. Doesn't quite look like a value buy. I bring in that 200-day simple moving average. Again, here, if you bought this stock back in May when it fell below the 200-day moving average, when that yield on cost was 2% or higher, that would have been the optimal time to have bought the stock here in 2018. But, what are we looking at? Okay, price. Okay, right now I would wait for this one to definitely come down either near or below that simple 200-day moving average, or for that yield to kind of climb back above that the price. Now looking at its return on capital invested, you can see over the last several years, this company back in 2013 has pretty much returned a 10% or higher return on your invested capital, which, when talking to other investors in my Facebook group, they said 10% or higher that's what you're shooting for when you're investing in any company. You want to look at over the last 1 to 5 years is pretty healthy there. Here we have that cash conversion cycle. This one does look a little bit spiky, but again, if we bring in their comparables, that's what you have to do if you're trying to compare companies, is look at their comparables. So Home Depot and Lowe's, they do very much the same thing, pretty much right in line with their cash conversion cycle. How many days does it take them for your invested capital to push out cash flow and profits? Okay, so that's Lowe's. That's a pretty good looking company, but it does not look valued at this time. Now bringing in CVS Health, we bring in their price of sales, price to book, look at it over the last year. We're looking at a 0.37 price to sales. So its current price in comparison to the sales that it does, it's greatly undervalued at, a third of its sales. Its price to book is at a 1.7. So value investors look at these numbers and say, dang, that's that's a really good deal right now. That's a pretty good value. Okay, what is the issue with this company? Why is it at these levels? So next, price and dividend yield. Here, if you were to buy this stock, you're getting at a yield on cost of 2.94. You're locking it in at $67.94. Again, this is number 2. So price to sales, price to book, that met and exceeded the value opportunity. Now that yield traded above that price, that's that second value opportunity. So here, I would say this is really good too. And my third look at this price is trading below the 200-day simple moving average. So again, this is that third value buy. So this is like three triggers that are saying this could be a great value buying opportunity for buying into the stock. You know, its financials look really well. Its price to book, price to sales look really well. Dividend yield trading above that price. Price is below the 200-day simple moving average, but the issue that I have with this is over the last 5 years, this stock has done nothing but decline. Now, thinking on what kind of news is out there, and the reason for this is Amazon, JP Morgan, Google coming out, developing their own healthcare, the group, Amazon buying up the pharmaceutical company that develops drugs, prescription drugs. That's a competitor. So Rite Aid, CVS, a lot of those companies have been on the decline recently. So while it does look like a value buy because of its price to sales, price to book, price below the dividend yield, price below the 200-day moving average, this one just has been on the decline. Whereas if I look at Lowe's, and if I were to buy this one in May, where that price was below the simple 200-day moving average, the yield was above the price, the history of the stock is moving in the uptrend. If I bring in CVS here, so this tipped in 2015. That was 3 years ago. I look at my 3-year charts here. We're on the decline. Let's look at its financials over the last 3 years and look at its percent changes. So it does look like its net income revenue has been going up. Free cash flow has gone on a decline. Free cash flow being on a decline isn't bad. Looking at their numbers, they're still in the billions. So they still have plenty of free cash flow out there. It may be down here and there, but overall, this one just needs to kind of play out. This one, it does look like a great value buy opportunity if you believe in this company over the next 5+ years. But it could be really risky for the short term, especially with Amazon, JP Morgan, Google coming into that field. So, and we didn't look at the return on invested capital. Here, return on invested capital has been pretty low over the last several years. It recently jumped up over 10% and has been kind of coming back down. We'll see how this one kind of plays out kind of going forward if you were to invest in that one. Cash conversion cycle, 17 days from the time that you invest. They have been bringing this down, which is pretty good. You do like to see this number decreasing. So how long does it take them from your invested capital to either make a profit, turn into cash flow? So that is CVS. Does look like a good value buy right now, but at the same time, they have so many, that competition out there right now could whack them out. So Fastenal, looking at price to book, price to sales, we're looking at a 7.2, has popped up recently. Price to sales has popped up recently to at 3.4. This is just due to that price. They recently did either some earnings or something like that. I saw them on the news. So this one, had never really heard about them. Don't know what they do. We'll look at that here in just a second. But everything just recently popped up. They were on the decline, coming off their highs here in, let's see what it looks like, March. We're in their highs. Popped down all the way down, $48, broke that. So if you had actually looked, let's get rid of these price book, price to sales, bring in their dividend yield for the year. They had a point right here where their dividend yield did pop above that price, where you could have locked in at a 2.8, maybe a 3% dividend yield on cost, a price of $48. That would have been the optimal time. Here we can see the 200-day moving average. See right here at this time, right in July actually, the beginning of July, that would have been the optimal time to buy. So beginning of July, you would have locked in a $48 price point below the 200-day moving average. Also, you would have locked in what looks to be almost a 3% yield on cost. Looks like they just increased their dividend recently here. Yeah, right here. They announced they're going to be doing a dividend increase from maybe 36, 37 cents to 40 cents. That's not too much, but it's still a very nice increase. You can see they just increased their dividend back in October from 32 to 37, so that's a nice increase. So basically, half a year went by and they increased their dividend. So very fast growing company there, and dividends. Let's see here. So we were looking at price and dividend. So not a value buy right now. Price in comparison to its 200-day, not a value buy right now. But it does look like a pretty good stock here. If you look at its return on capital over the last 10 years, this one stays pretty consistent over 10%. Not only 10%, but pretty consistent over that 20% return on your invested capital. Cash conversion cycle, 190 days. I'm not sure what this company does, so this could be pretty normal for them. I would just have to do a comparable against who are their competitors, how do they do, what is their cash conversion cycle. But overall, this company does look really well, really good. Just not a value buy right now. Okay, Lakeland Financial, price to book, price to sales, 6.9 for price to sales, 2.5 for price to book. A little high for price to book for a financial institution. Now if we bring in their price and dividend yield for the year, we'll see that they're currently trading below their dividend yield. So this could be a value buy right now for their current price to yield. If you look at their price, the 200-day, they're currently below their 200-day moving average, so at $48.37 in comparison to their 200-day at $48.52. So again, could be another value buy right there. And let's bring in their return on invested capital. They're at a 10%. They stay pretty consistent above that 9%, so this could be a good one. Let's look at them over the last 10 years. So coming out of that slump here in 2008, they have consistently stayed above that 10%. So that's that, that happy spot. 10% or higher is a pretty happy spot to have on your return on invested capital. Cash conversion cycle, it's a financial institution. I don't ever see cash conversion cycles on any financials. If we bring in JP Morgan, I guess it depends on their services, but normally you won't see any sort of cash conversion because they don't have any products that they actually, they order and ship and make money off of, so you won't see that on these financial institutions. And I believe that was our last one, unless we weren't actually talking about United Financial Bank Corp. Let's bring in these numbers here real quick and see if I was I talking about them? No, I was talking about this one. Okay, so our last one here, price to book, price to sales. Okay, so this one here, okay, so price to book for a financial institution, I like to look at a 1.5 and below. So this one does look a pretty good value buy at 1.2. Price to sales has been coming down pretty good at a 4.0 price to sales. Taking a look at its price and dividend yield. Dividend yield is still over the price, but imagine if you had bought this one back during that pullback in February, March, you would have locked in a 3% yield on cost. You would have got it at nearly, below $16, and you would have got a nice ride up right now to $17.39. Now, it's not a bad buying opportunity. They probably, looks like they haven't increased their dividend for quite a while. They keep it pretty consistent. So if you like a flat dividend payout, then that would be the stock for you. But right now, let's see here. Their price to book, price to sales look pretty good. They're trading below their yield, which is, it's a value opportunity. Now, price to 200-day, they are above their 200-day. So it doesn't, let's see, how often does it trade below? You can see here, history of the stock here. There are times when the stock does trade below its 200-day simple moving average, but it is on the uptrend. So if you're able to buy it near or below that 200-day simple moving average, you're more than likely, if you were to continue and just hold it for the long term, you'd be in a pretty safe bubble there. Return on invested capital, we're looking at 3.16. That's actually pretty low in comparison to maybe its competitors here. I'm not sure if they're in the same field, what exactly they do. They could be doing loans, they could be doing all sorts of weird stuff. But let's move over to dividend.com now. So I'm going to still have Y charts here. I'm going to go ahead, start with my first one, which is Lowe's, and bring in their dividend payout. There, we already have their price right there. yield. Looks like they just increased their dividend. You can see it. Oh, we're looking at the long term. Okay, so here, this dividend yield says 1.92. This one says 1.63. This is more accurate. They just announced and increased their dividend, which is not showing here. Well, which is showing here, but not showing here for their new yield. So actually, if we were to look at this now, with this new dividend yield at 1.92, you're buying it over here. So yield is above the price. Due to the way that they just increased their dividend, this could be a good value buying opportunity for Lowe's. It's not trading below the 200-day moving average, but we should see this one move into the $110 position here in the next 3 to 6 months, or here in a little bit longer term, one year out. I would say that would be a pretty good outlook there for that one. 55 years of dividend growth. So back from 1963, if you're a dividend growth investor, Lowe's would be a great addition to your portfolio. Very low payout ratio, meaning that they could lose half their earnings, still be underneath that 100% payout ratio, continue to pay out their shareholders and raise dividends. Their ex-dividend is on July 24th, which would mean you have to buy the stock on Friday to be eligible for the ex-dividend date on Monday. You would then get paid out on the 8th of August. Next, we have CVS. Again, while it did look like it was a pretty good value buy opportunity, it just has been on that downtrend for the last several years. And with its competition of Amazon and everyone out there that's trying to jab at healthcare and pharmaceuticals, that could be a bit of a risky buy. So dividend growth last 10 years since 2008. Here we're looking at their price is below the 200-day moving average. It is below the current yield. This is showing accurate, they're matching up here, 2.92, 2.94. I mean, here, ex-dividend is on July 24th. That is Monday. Have to buy this one on Friday or prior to be eligible for the dividend payout on August 1st. Next, we have Fast. Fast has 7 years of dividend growth. Pretty high payout ratio of 62.5. I wouldn't consider this too high. If they, let's see here, what's their earnings per share? It's 256. It'd be very tough for them to lose half their earnings, but let's say that they lost half their earnings. That would give them $1.28 earnings per share. We divide that by their share price of $55.94, multiply that by 100. That's not correct. That probably wouldn't happen. Don't follow my math. My math there is terrible. It is what, 1 in the morning. 1 in the morning. I gotta finish up this video. Okay. What are we doing? Payout, growth, ex-dividend is on Monday. Gotta buy it on Friday. Get paid out on the 22nd of August. Next we have Lakeland Financials. Yield over price right now. Price trading below the 200-day moving average. So pretty good value buy right there. Dividend growth last 6 years. Very good payout ratio at 34.7. Dividend yield at 2.15. Monday ex-dividend date. Got to buy it on Friday or prior. You would get paid out on the 6th of August. Next we have United Financial Bancorp. We have the stock trading at a yield over price. Price over the simple 200-day moving average, which isn't terribly bad. It's right about average right now. It's still probably on the uptrend, but there's more, it's in the middle right now. It doesn't know whether it's going to go up or go down over the next short term. But over the long term, this stock has been on the up and up. So you got that going for you. Payout ratio. So this one we saw earlier had no dividend growth. We looked at that dividend over the last several years, has been flat as of 2015. They increase it and then stayed flat. Looks like they had special payout, stayed flat, increase it, stayed flat. If you're a long-term dividend growth investor, this may not be the stock for you. Payout ratio, not terribly bad at 40%. I would consider that pretty good. Ex-dividend is on July 26th, which is next Thursday. You'd have to buy the stock on Wednesday or prior. You would then get paid out on the 8th of August. So that is all the stocks we're going to be covering today. Again, we had Lowe's, ticker symbol LOW. It is trading at a value buy due to the recent increase in their dividend payout. So here, instead of that 1.63, think of it at a dividend yield of 1.92. It's 200-day. It's still trading above its 200-day moving average because it did recently do a hike. This one, you may want to wait for it to kind of come back down off those highs, but it could continue to kind of climb there. Not likely. But next we have CVS Health. Value buying opportunity, but at the same time has been losing price equity over the last 3 years. Take what you want there. Let me know in the comments below if you guys would invest in CVS yourself or if you hold it in your portfolio. Ticker Fasten now, ticker symbol FAST. This one here, quick look. What am I? Price over yield. Okay, so not a great value buy, but long term did look like a great stock to hold over the long term. Lakeland Financials, ticker symbol LKFN, United Financial Bancorp, ticker symbol UBNK. So that is it for this week's Stocks with X Dividends next week. Those are your 5 stocks. I try to wrap it up as quick as I could at 26 minutes compared to my 45-minute past video. So if you guys did like the video, remember to give it a thumbs up. I'm sorry I can't wrap these up faster. There's a lot of information. I know I skip over quite a bit of it sometimes, but I'm just trying to get as much information out of their financial metrics and do comparisons. And I would like to do comparisons, but at the same time, I did a comparison the last week with just 2 stocks comparing against 2 of their comparables in the same industry, and that was another 40-minute video as well. So these do take time, but at the same time, we screen many stocks at once, and we get a very nice, healthy-looking, group of 5 stocks that we can then look at and say, hey, Lowe's look like pretty good long-term buy and hold, 55 years of dividend growth, recently increased their dividend, has a very nice, healthy dividend increase year over year. Long-term, do I see Lowe's going out of business? Who are the competitors? Home Depot. Are they really that competitive? Yes or no, but they all have their good moats and their members that are, valued members. Anyways, quit rambling, Brent, and that is it, you guys. Thank you guys for tuning in. Again, if you did like the video, hit the like button below. Subscribe to the channel if you have not yet subscribed. And as a friendly disclaimer, I am not a financial advisor or tax professional. The information provided is my opinion for entertainment and fun. This is not investment advice. This is just me as a financial investor trying to help others make their money work for them, looking for some value buys out there in the current market. Thank you guys for tuning in. I will see you next time. Have a great day. Bye.